Is SOFI just a bank? Because if you think that it is just a bank, perhaps its valuation today shouldn't be where it is. You see, SOFI just released its best ever earnings in the third quarter of 2024, showing growth that is reaccelerating and margins that are expanding at the same time. However, there was one issue, there was one segment in the earnings that caused investors a little bit of concern, and I think anyone looking at the earnings can agree that it was a blemish on a near perfect earnings, and that is their tech platform. Now, I do understand the arguments for the slowdown in the tech platform and the fact that Anthony Noto did make comments that basically hinted to the fact that this whole tech slowdown is due to macro-related issues and not SOFI-related issues. However, this is not the video for that discussion. I'll be doing something separately, more specifically to the tech platform later on. What I am interested in now though is to consider the real bear case in front of us. Is SOFI just a bank? And if it is, what is its valuation? And so I'm going to be valuing each segment of SOFI's business, including the tech platform, to help us better understand its valuation, and discounting some of these business segments as we put it all together to understand SOFI's valuation and to see the difference in valuation if you consider SOFI as a bank or a fintech with a potentially thriving tech platform. But as always, potential is a dangerous word, so let's dive in. So even before talking about valuation, we have to set the context and understand why we are using certain assumptions in this valuation process. So I'll basically be comparing SOFI to companies like JP Morgan and Truist Financial, TFC. These are two of the top 10 financial institutions in the US, which is ultimately SOFI's end goal. So it's good to see how they measure up against these kind of companies. Now, on top of that, I'll also be comparing SOFI to its peers like Robinhood, Upstart, and Lending Club. Now, I'll be looking at these companies based on its member growth, their revenue, as well as their profitability. And once we understand this, we can have a look at how investors value these companies and do a comparable analysis based on the multiples that investors are assigning to these companies. And so we'll be doing the same thing more or less with the tech platform. The problem is many of these companies don't actually have their own tech platform. And so what I'll be doing is that I'll be comparing specifically SOFI's tech revenue to Marqeta and Encino. And so when it comes to member growth, I think there are a few things I want to point out in this analysis. When I was looking at JP Morgan's numbers between 2019 and 2021, they were actually reporting the number of household accounts. Now, after 2021, they suddenly switched to consumer accounts. And so there's some sort of discrepancy in their reporting, and I'm not too sure why, what's the reason for the switch. But basically because of that, some of the numbers that I was using initially was not so accurate. So what I've decided to do is to actually use the latest report in 2023 and to make some adjustment to the numbers based on what the CEO tells us. Now, because back in 2019, they had about 63 million household accounts, but according to this report, they actually said that consumer accounts grew by 11% since 2019. And if you consider that they have 82 million consumer accounts today, that would mean that back in 2019, they had 73.8 million consumer accounts. And because JP Morgan's numbers are so incredibly huge that when you put everything onto a graph, JP Morgan basically makes everyone else just looks like a straight line. So it's actually quite hard to compare the member growth on a graph. So what I did is to compare the ratio of SOFI's members to that of the other companies in 2019 and down how that has changed over the years till today. Now, if you take a look at this table, right, back in 2019, JP Morgan was around 85 times bigger than SOFI. Truist and Robinhood were about 11 times bigger than SOFI. Lending Club was 3 times bigger than SOFI, and Upstart at that point in time wasn't even listed yet. So if you take a look at how this changed over the years, you can actually see how fast SOFI has been growing their member count compared to the other companies. Because as of 2024, JP Morgan is actually only 8 to 9 times bigger than SOFI. Robinhood is 2.5 times bigger than SOFI, and Truist only 1.6 times bigger than SOFI. For Lending Club, now the opposite is true. Lending Club is now half the size of SOFI, which means SOFI is now the bigger company when it comes to member growth. And you can actually see that, in terms of Upstart, they actually told us that in the most recent quarter in 2024, they served about 3 million customers, and that would make them about 1/3 of the size of SOFI. And I think to me, this is a testament to how fast SOFI is growing. They're not just growing faster than the other banks, they're also growing faster than some of the fintechs people like to compare them with. And then we take a look at their revenue over a span of the same period of time between 2019 and 2024. Once again, this is quite hard to, have JP Morgan and Truist on the same chart because they have been in business for much longer. The revenue that they generate, basically makes everyone else look so insignificant. So for these two companies, I'll just be showing you this table over here, and you can see that, the revenue growth is a little bit lumpy for these two companies. However, for these two companies where they are in the business cycle, revenue growth is not really going to be the top of mind for them. So TFC, I would say, is probably somewhere in between where SOFI is and JP Morgan is. And so I'm using these two companies, like I said, to set a context for what SOFI has to achieve to become a top 10 financial institution. But if you take a look at the graph over here, when I compare SOFI to Robinhood, Upstart and Lending Club, now of these four companies, SOFI currently generates the most revenue. Now, during the last couple of years, analysts have always said that, SOFI is comparable to companies like Upstart and Lending Club. But as you can see from this, revenue trend, that is not true. Because in 2022, when the rate hike cycle began, Lending Club and Upstart saw revenue decline and they basically stagnated while SOFI continued to grow revenue and in fact eventually overtook Robinhood. So this should basically signal the fact that SOFI's revenue is of higher quality than Upstart and Lending Club, and they do not rely solely on loan originations to drive growth. So I do not understand the whole narrative that SOFI is just primarily a lender. Now, when it comes to profitability, I want to start by drawing this dotted line over here and, just basically saying that this represents the break-even point. And as you can see, Lending Club is barely profitable. You really have to squint to take a look and see that they are profitable. Upstart is not profitable at all. And the two companies that have profitability inflecting upwards is actually Robinhood and SOFI. Robinhood is actually another company that has impressed me, and to just go off on a slight tangent over here, I really hope that they come to Singapore soon, because just to add my 2 cents, I don't actually think Robinhood and SOFI are in direct competition. I think yes, they are both fintechs, they both have certain areas of their business that do overlap, but I think in general their target demographic differs quite significantly, and that's perfectly fine, because to me, when I look at fintechs, to me their competition is not each other but legacy banking. Because I remember in the days when I first started investing, having to pay $10 to even $25 commission each time I executed a trade, and that was quite insane. And so this is what companies like Robinhood and SOFI are fighting against. So personally, I'm happy to see both of them do well. I don't think it's either one or the other. I think both of them can do well at the same time. In fact, I want to see Robinhood grow even bigger so that they can start their international expansion even faster. And so at this point, we have noticed that SOFI's customer growth has been faster than its peers. They're also growing revenue faster than its peers, while companies like Upstart and Lending Club, who are often compared to SOFI, have shown declining or stagnating revenue in a high rate environment. This is a strong indication that SOFI's revenue profile differs significantly from companies like this, which is why we are not affected by the high rate environment. Now, in terms of profitability, both Robinhood and SOFI do have an upward trajectory, so that's very good to see. And so we have to keep this in mind as we look at the tech platform, and then we tie it all together at the end. Now, when it comes to the tech platform, because we don't have that much information on really the back end workings on it and things like that, what I'll be doing is to look at its growth over the last 10 quarters, starting from the first quarter of 2022. And like I said previously, I'll be comparing SOFI's tech platform to Marqeta and nCino. Now, these two companies are often seen as competitors to SOFI, so or at least their tech platform, and so that's why I'll be comparing it with them. Now, if you take a look at the revenue, you'll realize that both Marqeta and nCino actually have slightly higher revenue than SOFI. They generate revenue anywhere between the $120 to $130 million mark in the latest quarter. However, SOFI's tech revenue only came in at $103 million. Now, I just want to speak a little bit about the large drop in revenue that you see here from Marqeta. The thing about a lot of these smaller companies is that because they are small, a lot of their revenue is actually quite concentrated among a few clients, and this drop that you see here for Marqeta's revenue is due to a contract renewal with Cash App, and then basically they had some sort of reduced pricing, certain different way of presenting the revenues and things like that. Now again, this is actually not a big issue for me because SOFI have other segments of its business to actually make up for it should such a thing happen. And whether we like it or not, right, the tech platform currently is SOFI's smallest portion of their business, which is quite ironic to say. Now, on top of all of this, when it comes to profitability, SOFI's tech platform is definitely profitable, about 30% contribution margin. Marqeta, apart from that one quarter with the one-off item, basically they are not profitable. And Encino, although they look unprofitable on the surface, at least they are starting to generate free cash flow of about, I think, $4 to $6 million this quarter. Now, the issue I have with valuation here is that, SOFI's tech platform is part of SOFI's entire business, which, operates like a bank. And what that means is that the free cash flow really isn't the best metric to use, because this number will be skewed for banks that actually originate loans. And it's very hard for us to actually understand the free cash flow that comes directly from SOFI's tech platform. But all in all, I would say that Marqeta and Encino, perhaps I would view them as slightly unprofitable to borderline profitable, with both of them generating about 10 to 15% more revenue than SOFI. And so, like I was saying earlier, SOFI here, basically they are generating around $103 million in revenue with a 30% contribution profit margin. And so personally, for me, I'd rather be making, slightly lesser in revenue but being hugely profitable than having the 130 million or so in revenue but not being profitable. Now, another thing, that I found with Encino is that actually their stock-based compensation over the last 3 years, right, have actually been more than 10% of their revenue. So I'm quite surprised that, these analysts that are so bearish on SOFI are actually okay with this level of stock-based compensation. Because personally, for me, I would actually feel quite uncomfortable to actually not see this number decreasing over the years, but I think to each his own. So I'm going to be looking at the valuation of each of the individual companies compared to SOFI, and then basically what we hope to do is to model in the loan platform business, which is new to SOFI's overall ecosystem, and the tech platform to basically see what kind of valuation we get. Now, this is actually just a starting point. There'll be more videos definitely in future that deep dive into the individual business segments of SOFI and how each of them affects SOFI's valuation. Now, the reason why I'm using price to sales over here, it's not because I think this is the best metric, but I do think because of the nature of the different businesses that we are looking at, different levels of profitability and where they are at the business cycle, the PE ratio may not be representative of all the companies out here. Neither is free cash flow, because free cash flow is a good measure for tech companies, but not for financial institutions. So neither am I implying that, these companies are undervalued. This is basically just the reality of what people are currently paying for these companies, and that's what we'll go with when we do our valuation. Now, as you can see over here, SOFI is trading at about 5 times price to sales. And if you consider the weak revenue growth, even stagnating revenue growth of Lending Club, I would think that, this is actually justified that Lending Club is only trading at 1.5 times price to sales. Now, whether or not SOFI should only be trading slightly above JP Morgan and Truist, who are trading at 4 times price to sales, is really up for debate. I would think that based on the revenue growth, if these other financial institutions are trading at 4 times price to sales, SOFI can perhaps command a 6 or even 7 times price to sales. And if we look above SOFI, we actually find that, Robinhood is trading at about 11 times price to sales and Upstart at 11.75, let's call it 12 times price to sales. Now, I can understand Robinhood's valuation in a sense. I think perhaps sentiment is also playing a part here. But if you look at Robinhood's revenue growth, in 2023, it was 37% and 29% this year, compared to SOFI, who had 36% revenue growth in 2023 and only 22% this year. And on a net income basis, definitely Robinhood is generating more net income than SOFI as well. So that is why perhaps, Robinhood does justify its slightly higher valuation than SOFI. But whether or not these slight differences in profitability and revenue justify SOFI only trading at half of Robinhood's valuation is really up for debate, and that is really subjective. Personally, for me, as a SOFI shareholder, I might be biased. I personally think that, this is not justified. I think perhaps they can be trading, like I said earlier, at maybe 7 times price to sales if Robinhood is doing 11 times. I think what is really surprising to me is Upstart's valuation. I mentioned in my previous video that I link over here, right, that, in the first quarter of SOFI operating their loan platform business, which is basically Upstart's entire business, SOFI is running their business at around 80 to 90% capacity of what Upstart has been doing, and Upstart has been doing this for years and years. And I do think that the quality of revenue that SOFI generates from originating these loans is much higher than that of Upstart's, because there is no loss sharing agreement, neither are there any financing agreements. And to top it all off, actually Upstart's trailing 12 months revenue only comes in at 600 million. So that is even lower than Lending Club, and somehow they're trading at 11.75 2025, let's say 12 times price to sales, even higher than Robinhood. And so if you consider all of that, basically Upstart's revenue is a quarter of what SOFI is doing. On a net income basis, Upstart generated negative 168 million compared to SOFI's 214 million. That is a 382 million difference, and somehow Upstart is worth double of SOFI. And if you look at the companies here, on average, I would say that the price to sales is somewhere between 8 to 9 times price to sales. And if you take a look at the tech platform, before their most recent earnings, Marqeta was actually trading at 6 times price to sales before eventually falling to 4 times price to sales. And Encino is trading at about 9 times price to sales. Now, if you take an average, that is about 7 times price to sales, and that's what we're going to use to value SOFI moving forward. And so this is the real geeky part. I think in the stock market, there tend to be narratives that people build around companies. People go out into certain news outlets and news networks and basically give all these one-liners that, come out as headlines and things like that. But I always felt that actually it was the numbers that tell me a better story about the company rather than all these headlines. And so, these are not buy and sell recommendations. It's basically doing back of the napkin kind of math to try and understand what some of these narratives around SOFI means and whether or not they hold any weight. Now, I'm going to be breaking this valuation segment into 3 components. I was actually, trying to think about how best can I actually present some of my ideas across so that you can understand what I was trying to say. So if there's any confusion at all, please feel free to let me know down in the comments below. And while you're at it, don't forget to hit the like and subscribe button as well if you enjoy this type of content. Thank you for your time, and back to the video. So the first scenario that we'll basically be looking at is SOFI's valuation if the lending and financial services component of their business doesn't grow, and the only thing that SOFI does in 2025 and 2026 that is additive to their revenue is to run the loan platform business. Plus, the tech platform is basically a cherry on top business segment and nothing big. Okay, so these are the assumptions we'll be using going into the valuation, not just this first scenario, but the other 2 scenarios as well. So although Anthony Noto did say that it's likely that they're going to do, somewhere between, in fact, more than 4 to 6 billion in revenue for this loan platform business in terms of the originations, I think what we're going to do for our valuation process is to just use the 4 to 6 billion dollar number and to not project out any more. Right, because any more than that is really just hopium. So the most recent quarter, they received a 6.1% fee on the $1 billion of loan originations. But they actually did mention during the call that, this fee is actually not fixed. And then based on the partners that they are working with, this fee can differ. So because of that, we'll just take a 5% fee. And as you can see in this yellow box, that's the annual revenue that we can expect to add based on the different originations from 2025 and 2026. And also the basic assumption here is that in 2025, the range of the loan originations will be between 4 to 6 billion, and going into 2026, as rates continue to lower, then the range will be between 5 to 7 billion. And when it comes to the tech platform, there are basically 3 scenarios that we want to consider. The first one, where the tech platform is just a cherry on top, growing in the low to mid-teens forever. The second scenario is basically a vertically integrated fintech growing close to 20% in terms of their tech platform. And the third scenario is where they perhaps become the AWS of fintech, and they'll have to reaccelerate growth here if they want to meet their 25% CAGR. So 25% growth in 2025 and 30% growth in 2026. So this will be my bullish assumptions. And so basically based on what we have gone through earlier about the different companies and their valuations, we'll be assuming a price to sales for SOFI's lending and financial services to be about 8 times, and SOFI's tech platform to be trading about 7 times price to sales. All this, like I said, is based on what people are paying for companies in the similar sector right now. So if you take a look at this Excel over here, there's a switch in this gray box. And so basically the number that you see in this gray box here, I can switch the numbers from 1, 2, and 3. And what I want you to take a note of is this sentiment box over here. As I change the switch from number 1, you can see the sentiment changes. So number 1, switch 1 basically represents a bearish sentiment. 2 represents our base case, and 3 represents a bullish sentiment, right? So if I put number 1 in the switch, which is the bearish assumption, this basically takes the numbers from over here. In the bear case, draw your attention to this box at the bottom over here. When I put the switch on top at number 1, the bear case over here will assume that in 2025, the loan platform business does 200 million in revenue, tech platform grows at 15%, and in 2026, loan platform business generates $250 million in revenue, and tech platform again grows at 15%. if you assume a share dilution of around 2%, I think the amazing thing here is that you still get to $21 by 2026. If I'm going to highlight this number for you over here if you haven't noticed by now, which is actually already very close to the first level of Anthony Noto's PSU. Right, so you can actually see, even in the most bearish scenario, that the lending platform, that the rest of the financial services doesn't grow, SOFI can still just about reach Anthony Noto's first level of PSU. Now, if we switch this to number 2, the sentiment now is our base case. Basically, you can see that the implied share price in 2026 goes up to around $22. And then similarly, when we change the switch to 3, we have the bullish sentiment. Then our implied share price in 2026 will be about $23. Basically, in our second scenario, what I hope to do is to show you an extreme case of SOFI's tech platform going to zero. Now, I think a lot of these bearish analysts out there always say that, SOFI is just a bank. They don't really talk about SOFI's tech platform at all. So let's presume that SOFI's tech platform goes to zero. So basically, if you take a look with me, back at the Excel file, we will change our switch to 2, which is our base case assumptions. For the tech platform revenue, we'll change that to 0. Everything will change to 0 over here. And then you can take a look, right? If you assume that the tech platform is 0, contributing 0 revenue at all, today, I'm not talking about 2 years later, 3 years later, today, SOFI should still be worth $15.30 as just a bank. With lending not growing, with financial services not growing, and tech revenue going to 0, they should still be worth $18.50 in our base case and about $19.20 in our bullish scenario. Now, at this point, I hope you can see how misunderstood this company is. I basically take out one whole segment of their entire business, stop growing the business segment that currently generates them the most revenue, and yet we are still undervalued today. Now, and finally, we look at some reasonable assumptions for SOFI's overall growth in its revenue based on past projections. Now, in this example, I'm basically only going to be looking at the base case. And in the base case, we assume that SOFI manages to meet expectations of 25% CAGR until 2026. Now, let's take a look at how they actually reach this 25% number. For SOFI to actually grow 25%, that would mean they need to add an additional $520 million in revenue next year in 2025 and $659 million in 2026. Now, if you use the earlier assumptions that we talked about, right, we have the loan platform business, and you see that actually generates around, in the base case, $250 million in revenue in 2025 and $300 million in revenue in 2026. Now, you take all of that out from the revenue that SOFI actually needs to add going forward, and you end up with an extra $277 million in revenue in 2025 and $359 million in revenue in 2026. Now, at this point, if you're confused, all it means is that, I need to generate $520 million in revenue. If the loan platform business can actually generate me $250 million, then all I'm left with to actually do with the rest of my business is $277 million. And so this $277 million, why is it significant? It's actually representing a 13% year-over-year growth in lending and all of the other financial services platform that currently makes up 80% of SOFI's revenue. So the lending component of SOFI's revenue plus the current financial services, excluding the loan platform, only needs to grow at 13% in order for them to achieve their targets. So that is really, really doable for SOFI. And if you zoom out and you use the same assumptions for the tech platform, which means that you assume the base case for the tech platform, it doesn't become the AWS of Fintech, but it stays as a vertically integrated Fintech with some cost benefits and the occasional clients being added, then SOFI should be worth somewhere around the $27 mark in 2026. So the next time you read something that tells you that SOFI is just a bank, always remember that SOFI being just a bank is actually worth $15.30 today on the 11th of November 2024. But the truth is, this calculation that we just did doesn't actually tell you the whole story, because the real growth driver for SOFI lies in its member count, and this method of valuation doesn't account for the effects of member growth on the valuation of SOFI. Now, I've spoken about this previously in this video over here, but if you're watching this at a later date, I'll probably be linking a second video over here where I'll be talking about my updated valuation of SOFI based on its new trajectory of member growth. And with that, I will see you in the next one.